Greetings, everyone. Well, it's Employment Friday, and so here we are again. But it's a special Employment Friday, so we have a few extra segments, especially now that we are so close to the election. Now, who is going to win this election? It is very close if you're looking at most polls, very close. But I am going to be speaking about the election at one point based on some of the online polls out there, which are moving in tandem with whoever is moving ahead, whether it's Trump or Harris, and it's been behaving consistently over the last 6 to 9 months, interestingly. So we wanted to present that fact to you first, and then talk about what the market might be trying to telegraph with its moves. Now, we do expect the election to be some kind of trigger event. And so there could be a great deal of volatility, no matter who wins. But one thing we want to communicate is that innovation gains traction during tumultuous times. Remember what happened during COVID. Innovation gained traction. People, businesses, consumers are willing to change the way they do things, move away from inertia, and really change their habits when they are concerned one way or another about the future. So we're not saying who is going to win. We're just trying to understand what the market is saying by its recent behavior. So, but before that, we will have our chief futurist, Brett Winton, on. Brett and I and our Multiomics team, we are now have a new drum roll. The drum rolls that you've heard before, Bitcoin in 2015 when it was $250. Tesla, well, practically our entire existence, but especially during production hell during 2018 and 19. And now we feel like the most misunderstood part of the market, the most inefficiently priced part of the market, is innovation in healthcare, and how innovation in healthcare is going to transform healthcare completely, and it's really going to transform business models, transform the pharmaceutical business model, the biotech pharmaceutical model, especially as it relates to patents and generics. So we go through it in quite a bit of detail because there has been so much volatility recently and such misunderstanding of how profound the impact of the convergence among AI, sequencing technologies, and gene therapies, especially gene editing, CRISPR-Cas9, how misunderstood this new world is. And so we want to expose you to it, expose you to some of our original research, just as we did with Bitcoin and Tesla. We think this is an incredible new frontier. So after Brett and a few comments about the market and the election, we will go through the traditional drill from Employment Friday: fiscal policy, monetary policy, economic indicators, market indicators, and then we'll end with a message on innovation. So Brett, take it away.
Yeah, sure. And I think there is kind of the process of drug discovery and getting something through a clinical trial. We think that's going to improve because of AI and biomarkers you'll be able to use to kind of like accelerate your throughput and increase your odds of success in clinical trial. And I'd encourage you to go to the FYI podcast where we just had a great conversation released with Absci's founder, which is a company that's really going after this, using AI to make drug discovery more efficient. And the tools that we get, as Cathie described, that we're able to use, like gene editing, have the promise of delivering a cure after you do more efficient drug discovery. There's this perception that cures might be bad for business, and actually that's wrong. It's wrong profoundly. If you look at the average rare disease in the U.S., the way that drugs currently monetize against rare diseases is that you spend on average roughly $8,000 on prescription drugs, and then you spend an additional $36,000 per year on hospitalizations and inpatient care, and very costly things. And so if you look at a prescription drug going after that $8,000 worth of prescription spend, the net present value, or the asset value of that, would be around $100 million. So you can understand why often drug developers don't even go after rare conditions, because the rare conditions are so small. If it costs you $1 billion to develop the drug, well, $100 million isn't that much. Well, we think cures, using the same patient penetration, could be worth around $2 billion a piece rather than $100 million. So roughly 20 times more. And so that's the bar on the right. If you compare that even to a drug that you're bringing to market that addresses and actually fundamentally addresses the rare disease, it eliminates the symptoms that the patient has, maybe even it addresses the root cause, but the patient has to take it monthly or every 8 weeks, that's still less than half as valuable as a prospective cure. Because what a cure does is it gets better pricing because it avoids a lifetime worth of costs, it delivers better patient outcome, and it pulls all of that revenue forward. So rather than using up your addressable market in a negative way, what it does is it takes revenue that we would otherwise lose to competition in the future once your patents expire and brings it forward. And so the cures aren't actually bad for business. Even like for like, delivering the same patient outcomes, we think they're 2x more valuable. And there's plenty of evidence that Wall Street doesn't understand this today, the way they're treating, even incremental results from the likes of Intellia, which is developing a cure for hereditary angioedema, and CRISPR Therapeutics, which has a cure generating revenue, we think, this quarter for sickle cell disease. We don't think that people actually understand what these dynamics look like. And so
I'll just add an exclamation point on that. If you look at the valuation of Intellia today, so I'm just pulling it up now. Intellia is, its enterprise value today is $654 million, $655 million. Its market cap is $1.5 billion, but it has almost $1 billion in cash. It's burning a lot of cash, to be sure, and those sorts of stocks have not done well in this environment. But what Brett is going to explain in terms of the value we see coming out of a drug that cures HAE, as it is known, will astound you. So do you want to put that into perspective?
Yes. Yeah. Let me go to the next slide. And this is for the average rare disease, and I'll explain how it translates to HAE, which is Intellia's target. So cures get to much higher premium pricing than traditional treatments. And this is a waterfall that shows why. Relative to $8,000 in prescription drug spend, you also avoid all the future drug spend you're going to do for that patient. So that's the first two bars. And you avoid a lifetime's worth of hospitalization and acute care costs. And so that collectively is worth $400,000 present value. And you deliver better kind of patient life years. And payers will they will pay for you to actually, extend people's lives. It's always cheaper to let somebody die, but we thankfully as a system want to have people live normal, healthy lives. And so the net present value of what they'll pay in a typical treatment is $600,000. And that revenue stacks up to, for the average rare condition, a $1.1 million price tag for a cure that insurers would be willing to pay. In the case of HAE, as Cathie's describing, the current medicine that people take when they have that disease is $500,000 a year. And so over the course of the patient's lifetime, it's really $12 million in spend on the current medicine that exists. So if you do the math, those drugs are actually overpriced relative to the costs they abate and the life years they extend. But so even if you adjust them down to a fair price and then say you're coming to market with a cure for that condition, it should be around $3 million for a cure per dose. And you deliver that to a patient one time. So the insurers, it's actually a great payback for them, as opposed to spending $500,000 a year over 20 plus years of life for these patients. They pay one time $3 million. And then from the patient's perspective, it's amazing because you no longer have to take injections monthly that actually don't do a great job of managing the conditions. You become a normal, healthy, normal or abnormal, whoever you are, you no longer have to worry about that disease. And so that's now what's interesting with HAE. So there's 7,000 people that have it in the U.S. At $3 million times 7,000. That's a $20 billion market if you deliver a cure for that. And so we don't know, how quickly it's going to penetrate that population, and they're still just entering phase 3, so there's no guarantee that Intellia is actually going to deliver, a drug that gets approved here. But relative to the market cap that Cathie just described, you can make reasonable assumptions that result in that asset alone, forget the rest of their pipeline, some of which are ostensibly much more valuable than that, can generate cash flow in excess of the value of the business within a couple of years. And for a few years.
Yeah, and one of the reasons we're focusing on this stock is it reported results of a phase 2 trial, or the extension of a phase 2 trial, which only 11 people, 8 of whom were cured, or they had no attacks. They were attack-free, as they say. But 3 had self-reported. The patients, the trial is depending on patients to report. 3 reported that they did have attacks. And this disease is, it tends to, the people who die from it, they die from suffocation, from swelling. And so what we believe is going on is, since they are self-reported, if they're having an attack, they're probably going to respond to almost anything, because this is a terrible disease, and they've had these attacks regularly. So that's the controversy. Is this a cure, or is this not a cure?
Yeah, and in some ways, I actually don't think that it matters as much as people believe it does. If you go to the next slide, this can kind of help illustrate, because imagine that you have a treatment that's a one-time dose that then for 80% of the people that take it, it reduces the bad protein that is being generated by your body sufficient that you no longer have the disease. Well, okay, so if a cure is worth $3 million, well, then maybe payers pay $2.5 million for that, because everybody can take it and only 80% respond. That's still a great savings to the payer at that price point. And because of if the existing treatments, even phase 3 type treatments that are coming to market, they are designed to give patients the maximum dose that the patient can withstand over time without having some kind of toxic response, to reduce the protein levels so the patients don't experience these attacks. Intellia, because it's a cure that they give one time, it's possible that even that 20% of patients that don't respond, they could give them another dose 3 months later. and they might cure another 80%. And so it seems likely to me that because of the way they're delivering the drug, it's easy for them to redose. They could charge $3 million for a cure, and it just so happens they have to administer a couple of doses to some of the patients, and some of the patients get it one time. And how this will play out competitively versus other drugs in the marketplace is even very effective treatments that are requiring patients to take injections every 4 weeks and really reduce materially and almost completely the rate of attack. Those patients will have the option to be like, oh, maybe I'll try this cure thing. I just have to spend 2 hours. I never have to worry about injecting myself again or any of the side effects that accompany that. That'll become a one-way valve where, even a very effective treatment is still not going to be the same to the patient as never having to refill the prescription again, not having to worry about carrying around needles and drugs. And so this graph shows the comparison of the revenue curve for a typical cure versus a typical very effective treatment that you are dosing regularly. So this is comparing something that literally cures the disease to something that effectively cures the disease. You just have to keep redosing in order to maintain your effect. And the revenue curve for a cure, you can see you're upfronting the pricing and you're actually capturing some of the revenue loss that would happen after patent expiry. And the cure is 2 times more valuable on that basis.
And we should also mention that CRISPR therapeutics, which you did mention early on, sickle cell disease, beta thalassemia, these therapies have been approved in the US, UK, and Europe. And the patients are entering the trial or being dosed now, I should say. So we're going to see real revenue recognition when CRISPR reports, and we'll get some guidance on how that plays out. The difference between CRISPR's therapy is it is so-called ex vivo, meaning they take the cells out of the body, condition them, and then put them back into the body. Intellia's methodology, which CRISPR is also working on, is in vivo. This HAE cure is they dose the patient directly, do not pull the cells out. So we think the excitement here is, we're very excited. The market is not. And this is another great example of being in the flip side of where we were during the tech and telecom bubble. During the tech and telecom bubble, had this kind of company been this far along, they'd have been throwing money. In fact, it could be just a gleam in the eye and they'd be throwing money at it. Today, here we are, curing diseases. That was the promise in the tech and telecom bubble, that we were going to have personalized medicine and cure disease, and biotech boomed just like tech and telecom. This time around, you have investors very fearful, and it's because of the cash flow characteristics. Of course, they're investing aggressively now. As Brett just described, these are massive opportunities and will be unbelievable for humanity. So we are starting to beat the drum now on this. You've heard us beat the drum before, first on Bitcoin in 2015, then on Tesla around the same time, but even more so during production hell during 2018 and 19. And now we feel it's really important to educate investors and really everyone, because this is our healthcare, and the future is really bright. So, Brett, I don't know if you want to.
Yeah, I mean, I think I do want to say just one more thing, which is what I find so fascinating about it is there really is, one, a misperception that cures are worse for business. Two, it's partly because we haven't really seen it happen yet. So the sickle cell disease is coming to market, but we don't know yet what the revenue curve looks like. And the commercialization of that particular asset is challenging because you have to take cells out of the patient. You have to, modify the cells. You have to re-inject the cells. The patient has to be hospitalized. It's a full of friction process. And over the course of, not just for Intellia and CRISPR therapeutics, but over the course of the next 5 years, there are going to be a number of prospective cures that come to market for diseases. And I think people will realize, oh, the revenue curve on these things looks very different than what we're used to. And right now, it's almost like they're taking the old revenue curve and then they're pretending it just translates and uses up all of the market. And so not pretending, it's more like they just haven't seen it and so don't yet know how to model it. And so we think there's going to be a change in the way people need to model these drugs, and that hasn't happened yet because they haven't seen the tangible evidence. And from a human-centered perspective, it's important that people begin to understand this, because we could be developing a lot more cures if these businesses were better capitalized. As in, like right now, Intellia is, they're focused on the assets that they're going to get into market so they can prove that it works. And then, their strategic ambitions, as is a number of other companies, is then begin to build up the pipeline to address additional rare diseases. But the sooner kind of Wall Street or the capital markets realize how valuable these things could be, the more quickly we'll be able to develop cures for these diseases, which can be, yes, great businesses, but also great for humanity.
Right, and we witnessed the golden age of healthcare. I did early in my career, where the returns to R&D in the healthcare space moved from single digit up into the 20 to 30% range in the golden age as Genentech launched. Now they're back in the single digit range. And yet we believe that the convergence of these technologies is going to cause significant returns, much like Brett has described here, to R&D, probably surpassing what we saw during what many people remember as the golden age for healthcare. And it is the convergence of sequencing technologies, artificial intelligence, and gene editing, other gene therapies that are going to lead us to a world of preventative medicine, predictive medicine, personalized medicine, and participatory medicine. So Nemo is one of our analysts, and he is writing papers about this exciting new age. And Brett, along with Rong, have been really focusing on just how dramatic the revenue profile dramatically the revenue profile changes, bringing much more revenue upfront and moving and really escaping the generic cliffs that traditional pharma and biotech are facing today.
Yeah. And like, because it's a cure, people are right about one thing, which is that, well, when you develop a cure, you do use up the market. And so this is, for every disease, this is, kind of a one-time thing. As in, you'll cross a threshold, deliver a cure, then, the marginal competitor is no longer going to look at that indication as something that is a meaningful market for them to address. And so it's actually a very interesting, I think, tipping point in what drugs can do for humanity. And from a business perspective, interesting, and obviously from a human perspective, like, amazing.
Right. Well, so we're going to be paying attention, and the human perspective, and CRISPR Therapeutics has shared some of these facts with the market. But the first person in the beta thalassemia trial, which was, I think, more than 4 years ago, he went to the hospital on an emergency basis roughly 17 times per year for blood transfusions as he was having an attack. Since entering the trial, he has not had to go once for a blood transfusion. He is effectively cured. And I've always said no news is good news. There are many, many trials going on in this space, and they have not been stopped because this is a very safe therapy. Jennifer Doudna, who is one of the inventors of CRISPR-Cas9, basically said the same thing to us very early on. She says, no news is good news. Well, now we are going to hear news, and we think it's going to be good news, and we'll start to see it translate into revenues for these companies. This is not 5 years from now. In the case of CRISPR Therapeutics, it's now. So thank you, Brett. I'm
My
excited.
Pleasure.
Yeah?
Yes, and we'll see. And also, just one caveat. I mean, with clinical trials, there's always the risk that things break poorly within the patient population, things that could be in the company's control or outside of their control. You know, more than any other space, kind of the positions in multiomics are more volatile and idiosyncratic. And so I think that we can say with assurance that over the course of 5 years, there's actually going to be a number of cures that come to market. And we can say with assurance that CRISPR Therapeutics has an effective cure for sickle cell disease. And we'll see exactly how kind of the revenue curves and the prospective trials play out. But the results so far look very promising.
Yes, and you heard it here first, I believe, because we're doing this research. This is what we do, truly disruptive innovation that's going to be transformative, transforming lives. So certainly a profound case in point. So thank you, Brett.
Thanks.
Thanks. Okay, now we'll go back to the normal drill. This time we will we'll start with comments about the election, the pending election. At least the vote will take place and finish next Tuesday. And it certainly will have important ramifications for the economy and the markets, we believe. Then I'll go into fiscal policy, monetary policy, economic indicators, and market indicators before ending on a note about innovation. So let's start. So this is from Predictive. I think that's the name of the survey. And you can see here the S&P 500 is the green line, and the odds that former President Trump will win, that is the purple line. And it's interesting to watch the market's movements as the polls have shifted around. There is a correlation here. Now, I don't know if President Trump is going to win. It does seem like the polls are breaking for him. And so we'll talk about just a few election issues that are on people's minds. Of course, taxes. And the market likes tax cuts and has been worried that the tax cuts in the original tax bill that was passed under President Trump, that they are going to expire at the end of 25. So one reason the market is behaving this way is, of course, he is not only going to be a proponent of extending those tax cuts, but he has said he would like to introduce even more tax cuts, personal tax cuts and corporate tax cuts. Now, the other thing that he has suggested and is beating the drum on are tariffs. Now, the market generally does not like tariffs. I don't like tariffs. I don't like any tax increase. But I think what we're beginning to understand is that the tariff talk is a negotiation already with our trading partners. But it is also a trade-off, much like in the very early days of our country. We didn't have the personal income tax. All we had were tariffs, and these started under President Washington. So I think the market is beginning to understand that we're talking about, one, a negotiating posture here, so posturing, but two, we might be thinking a little bit about going back into the world that we actually did enjoy in the early days of this country. So that's interesting. The other thing that we hear former President Trump talking about is the dollar. He wants the dollar down. Ironically, the dollar going down is good for multinationals. But the dollar going down typically does not happen when the terms of trade start to favor the U.S. And cutting taxes is definitely helps in terms of trade. The return on capital in the United States to the end investor goes up, all other things equal. That tends to be good for the dollar. It tends to invite capital flows. So maybe this is going to be rhetoric after all. Interest rates, another topic that former President Trump is pounding the table on. He wants interest rates down. Now, interestingly, if his policies are pro-growth, and we do think they are, including cutting regulations, then the odds are high that the growth rate in the economy is going to pick up. As you know, I believe we've been in a rolling recession since the Fed started raising interest rates. Really shocked us with the 24-fold increase in interest rates. And we've been suffering ever since. Now, the headline numbers belie that fact, but if you look at small business optimism, it's down at 08-09 levels. If you look at consumer psychology, it is low, and it has been falling. So something's not going right out there. If we do put in place pro-growth policies, then the odds are that short rates actually, maybe they won't come down as much as we think, depending upon how long it takes to put in place these growth policies. We do think rates will come down for the next year, that real rates are at a level where that makes sense, especially if inflation continues to fall, and we think that will happen. But if after that, after we get through this, getting rates back to some equilibrium level that makes sense, we could see short rates actually picking up in response to real growth. That is a natural result. Now, long rates may not go up as much. In fact, they might stay pretty quiescent. Why? And this would also be a throwback to the early days of this country, when we were on the gold standard back then, so very little inflation, and we saw an inverted yield curve, I think more than half of the time, because short rates were responding to rapid growth associated with, the Industrial Revolution, telephone, electricity, internal combustion engine. So we had some big growth spurts there. We had the roaring 20s there. But long rates did not go up as much as short rates, and in fact sometimes went down. So we had an inverted yield curve averaging 100 basis points. And maybe we're going back to some period like that. I don't know. I mentioned regulations. I think, and we've been saying for some time, that regulations do hinder innovation And in fact, they are strangling parts of our economy. In his first administration, former President Trump basically said, okay, if anyone wants to introduce any new regulation, they have to eliminate 2 others. And he'll probably put that in place again, if not more. So that we think will be very good for innovation and animal spirits. The big question is the deficit. And here I'm going to start rolling into the charts. So here you can see the deficit. It is not anywhere nearly as bad as it was during COVID, but we've never seen anything like that in history. It is not that far, however, from where we were in 08-09, and it's worse than in the early 80s when President Reagan came into office and the deficit got to 5%, which at that time had been unheard of. And the bond market was very upset. Investors were very upset. I think the bond market has been responding since the Fed cut rates. You'll notice long rates went up, and I think that's a response to the upcoming election and the focus on the deficit spending that both candidates seem to be talking about. Now, we believe that the deficit is going to shrink in the next few years because we do believe that growth is going to accelerate. The best way out of a deficit is real growth. And you saw that happened in the 80s under Reagan. Once we got through with the bad recessions and once the defense spending was intact back then, the deficit improved. It was cut in half. We believe that could happen again, especially in the environment I just described. And the other reason is because former President Trump is now focused on it. He wants to make Elon Musk the government efficiency czar. Now, I don't believe that Elon will take an official post in this administration if President Trump is reelected. But I do believe he'll put into place some rules-based system, much like the regulatory system I just described, that will cut government spending. Now, he says he could cut government spending by $2 trillion. I'm going to show you a few charts now, which will suggest how difficult that will be. He doesn't give us a time frame, and this could be over a decade. That's very possible. But you can see right now that outlays at $6.1 trillion are 22.7% of GDP. And you can see that only 1.7 trillion is in discretionary areas that can be cut. President Trump has said he is not going to cut Social Security or Medicare outright. But I do think that with the use of artificial intelligence, that we're going to see much more efficiency in the government, and that attrition alone, just individuals, employees leaving the government system, not replacing them, would go a long way during the next 10 years to shrink expenditures by $2 trillion. So, of course, we can't do this in 1 year, but over a number of years, we think it's quite possible. And then you can also see, so total outlays, 22.7% of GDP. Here's the deficit. Revenues are 16.5% of GDP. And you can see the breakdown here. And of course, there's a lot of confusion because President Trump says he wants to cut tax rates. And of course, All other things equal, that would boost the deficit, but all other things are not equal. Cutting taxes, cutting regulations, encouraging innovation is going to stimulate growth, we believe. And that is going to be the primary way out of the recession. More growth, more profits, more income, more taxes that way, a very healthy way. Here is the history of the individual tax rates. You can see the first one was put in place, I think, around 1913. Before that, we didn't have individual tax rates. This is the highest bracket tax rate. And you can see in the World War II era, we were up to 90% marginal tax rates. Who's going to work if they can earn only 10 cents on the dollar? That is not an incentive at all. We're in a much better situation right now, but I believe that Trump, along with one of his advisors, who is Art Laffer, we've spoken about Art Laffer before, Trump wants to get these tax rates down even lower, making that trade-off perhaps with tariffs. So we shall see. Then just wanted to show you a few more charts before I go back to the economic indicators, market indicators, and innovation. Here's a picture of the long-term Treasury yield. The nominal yield is in green. The real yield is in purple. That is the market responding to expectations of real growth, long-term, over a 10-year period. And you can see expectations for inflation in the black. They are coming down. And we think they're going to come down a lot more, surprisingly more, because of how deflationary these new technologies, robotics, energy storage, artificial intelligence, blockchain technology, and multiomics sequencing, how deflationary they are. Now, we just got through talking about, a $1 million cure or a $2 or a $3 million cure. We believe that these cures are going to save the healthcare system, which is now nearly 20% of GDP, save the healthcare system significant dollars. Why? Because pharmaceuticals and biotech drugs, these therapies, these cures, right now they account for something like 15 to 20% of the total healthcare budget. The rest is 80%. That's taking care of sick people. If we're going to have more cures, then that 80% should shrink or go more into these curative therapies. So we think there are a lot of dollars there. And I say that when I'm talking about inflation. I know a lot of people, their eyebrows are raised when we talk about $1, $2, $3 million cures. But there's another side to that, which could be very deflationary and disruptive to the healthcare sector. The next chart is, more on monetary policy now. You can see in the purple, the M2 growth rate. You can see CPI inflation. And after being stuck for a while in the 3 to 4% range, it has dropped. It's now at, I think, 2.4%. And we believe it's going to continue falling, and would not be surprised to see it go back below zero, especially because of what's happening with these new technologies. I've already mentioned what we think could happen to the yield curve. You can see that M2 is now at 2.6%. But what is starting to happen behind the scenes, and you've heard me talk about velocity before, the velocity of money, that growth rate, which peaked at 11% during COVID, is now flattening out sequentially. And we think it potentially could reverse and go down again, in this next year. So 2.6% is not very much growth on a year-over-year basis if velocity flattens out, because that 2.6% is accommodating both real growth and inflation. So I showed you the CPI in this chart down to 2.4%. The PPI, which is a leading indicator of the CPI, is below zero. You can see on this chart. So, and if you look at it, it is in the lower range of where inflation has been since the 1950s. And yet we have so many experts, economists, strategists out there talking about inflation reigniting or being stuck at a high level. This leading indicator is saying that that's just not going to happen. This is below zero, and we believe the CPI likewise could drop below zero. And then here, I've presented this chart a number of times. You can see the high correlation between the purple line and the green line before the Fed started tightening. There was a very tight correlation. It broke apart when the Fed started tightening, and we went into the rolling recessions. And Europe and China have also been in their own rolling recessions, if not outright recessions. For those reasons, the metals to gold ratio has dropped back to where it was during COVID and below where it was during 08-09. Again, the cyclical world is quite sick out there. And the interest rates have flattened out here. But this chart would suggest that to get this correlation going again, either long rates have to come down, the metals to gold ratio has to go up, or both. And if we do get into the pro-growth economy that we're talking about as we leave this rolling recession, or what others are calling a bumpy economy now, and we move into a better growth environment, the purple line will pick up. By that time, we believe the long rate will be lower. So before going into the last two charts, I'd like to just quickly go through the economic indicators, just referring to the employment report today. The employment report had, again, as they've had for the last 2 years, something for everyone on the positive side. The unemployment rate, which was not affected by the hurricanes, stayed at 4.1%. And the SOM rule, which has been a perfect indicator that the economy is going to fall into recession. When the SOM rule is triggered, it was triggered a few months ago. It was untriggered with this report. So that's good news. Initial claims after spiking during the hurricane have come back down, and the average hourly earnings index in this report was 0.4%. Expectation was 0.3. We think there was that mix impacted it because a lot of lower paying jobs were probably affected more by the hurricane. On the other side, the household employment metric, which also is not affected by the hurricane, that dropped, I think it was 368,000. So that was, and so household employment has not grown at all in the last year. Non-farm payroll employment, which was affected by the hurricane, the expectation was it would be 110,000. It came in at 12,000, and there was a downward revision over the prior 2 months, which dropped employment by 112,000. So there we go, another downward revision. And we saw in the JOLTS report that the quit rate is still falling. And the quit rate falling means people are a little fearful they're not going to be able to find another job, and that they can jump to another job for higher wages. So one interesting take on this bumpy economy or the rolling recession comes from Nancy Lazar's work. She's done some great work on bifurcation in the economy. And one of the biggest bifurcations out there is between corporations and non-corporations. Non-corporations tend to be small and medium-sized businesses. In the last 2 years, while corporate income has gone up 10%, non-corporate income has gone down almost 10%. And that is why SMID companies have been struggling in this market. And of course, our strategies are, for the most part, dominated by that ilk. Now into market indicators very quickly. The S&P, it has moved up, as you saw in that election survey, mostly out of optimism, we believe, that we're going to move into pro-growth policies. Interest rates have moved up because of fear of deficit spending, but spreads, so the difference between high-yielding bonds, junk bonds, and treasuries, and between corporate bonds, so investment-grade bonds and treasuries, those are narrow. They are extremely narrow. So what that means is the debt markets are not worried at all about the economy, which seems strange to us. And it may be because there has been a flood of capital, especially private credit, just seeking yield out there, and that's where the bubble is. The bubble is not in AI stocks. It's not. AI is real, and it's going to cause profound changes in the economy. The bubble could be in the private credit markets. We saw in the last month commodity prices fall. Again, that's cyclical weakness. We saw gold prices rise, and in fact, gold prices are now up 40% year over year. Why is that? Well, how about uncertainty? So safe haven money, geopolitical risks certainly have flared up significantly over the last year. And there is a fear that with all this deficit spending, that monetary policy will get out of control. So it's a hedge against that, for sure. If you look at Bitcoin, it has doubled over the last year. So gold up 40%, and Bitcoin's price up 100% to $70,000 for some of the same reasons. I think the wonderful thing about private money, which Bitcoin is, rules-based private money, is that it is going to give fiat currencies a run for their money. In other words, it's competition. Private money is going to be competing, much like gold is, against the monetary authorities, except with the private money, the digital world, we're going to be able to recreate the financial system and disintermediate fiat currencies if monetary authorities do not act in a disciplined way. So I'll just conclude with two charts here. And these charts they embody some of the worries out there. Many of you may have heard me speak of GovCal, Charles Gov, Louis Gov. They are strategists based in now Canada and Europe. And one of Charles Gov's fears is that the rise in the gold price is a harbinger for trouble ahead. You'll see that in the 50s and 60s, the same thing happened. And boy, did we fall into trouble. After, plateauing in the 60s, we went through the 70s bear market, and it was just awful. So there's been a bit of a tug of war between the S&P and the gold price in here. And so the bet is on. We are betting that the S&P, if the pro-growth regime does come into power, that this line will move up. The S&P will start rising faster than gold, and the gold price could even fall. Because there's going to be significant opportunity cost to holding gold if you're going to get great returns out of equities. And Charles's bet is that we are in an inflationary boom. He thinks that inflation is going to become a big problem. Now, we've given you some charts to suggest that we don't think it's going to be a problem. But that is the debate out there. And so we're watching this plateau carefully. And if it did start to tip over, you saw that it did in COVID and then came back. If it did start to tip over, we'd really have to address this. And then the final chart I'll show you is the S&P to crude oil. One of the reasons that Charles expects inflation to surge is he expects crude oil prices to surge. And it's all part of a global monetary reflation thesis. We expect the opposite. We expect oil prices to continue falling. But you can see the same thing happened in the 60s. After the 60s, this plateaued, and we went into a bear market. That was the bear market 70s, when oil prices soared and the S&P was crushed relative to oil prices. We expect this chart looks like it's in an uptrend, and we think that it will resolve to the upside. You see what happened during the COVID spike, and is going back there. And one of the reasons, of course, is innovation. Innovation solves problems. We do believe transportation is going electric, and that the vehicle miles traveled is going electric faster than the share of electric cars sold. Because we believe autonomous vehicles are going to be electric, and their capacity utilization can be 50-60% of the day, whereas our capacity utilization in our personal cars is maybe 3 to 5% per day. And the other reason we would expect oil prices to come down is if there is a Trump administration, that the investment in energy is going to surge again, and all kinds of energy, not just oil, but nuclear. That's already getting a lot of play because of AI and the data centers' consumption of power, massive consumption of power. So we do believe there's going to be a renaissance in energy production. So with that, I know this was a long one, but we wanted to showcase what we're going to be beating the drum on in terms of healthcare, this convergence between AI and sequencing technologies and editing cures. So I'll leave it on that hopeful note, and we'll know a lot more this time next month after the election. And we'll look forward to sharing more thoughts with you then. Thank you.